Welcome back to Ask a DHJJ CPA, the podcast where real CPAs answer real questions from business owners. I'm your host, Emma Yurchik. Today, we're focusing specifically on individual taxpayers. Whether you're filing a 1040 with W-2 income, investment income, pass-through income, or a combination of multiple income streams, there are important updates and planning opportunities to be aware of this year. So the question we're answering today is, what do individuals need to know this tax season, and how should they be planning ahead? I'm joined by Dominick Martin. He's a tax manager at DHJJ, and he works closely with businesses and individual taxpayers. Before we dive in, Dominick, can you share a little bit about your role and the types of individual clients you typically work with?
Hi, my name is Dominick Martin, and I'm a tax manager at DHJJ. I've been in public accounting for 15 years, and I've typically worked with businesses in the manufacturing, service, and technology industries. I've also worked closely with the individual owners of those businesses and also with high net worth individuals, and I have some experience working with professional athletes as well.
Awesome. Well, thank you again so much for being here. I really appreciate you taking the time to sit and chat with me today. So let's start with some of the basics. When people hear individual tax return or 1040, they often think it's straightforward. From your perspective, what actually makes individual returns complex?
So people might think that their 1040 is not complex just because they have only have like a W-2 and investment income and they don't own a business. But if those individuals exercise stock options or they have multiple brokerage statements that have different reporting of that investment income, they're going to need accountants like us to help them report that. So it becomes complex in that way. Also, if they own multiple rental properties, that could also complex their return as well. So, and then you look at the business side of things, business owners. So now business owners, and you guys kind of hit on it in a prior episode. So like, if the business starts creating an nexus, multiple states, that business return could also affect the individual state filings as well. So you want to just be able to see how that affects it on an individual level, and things could start becoming complex that way. Might have to start having multiple state tax filings as well.
Absolutely. I think you hit the nail on the head. Many people assume individual taxes are simple unless they own a business. But once you layer in investments, real estate, equity compensation, or even some side ventures, it can quickly become a lot more nuanced. So, what are some common surprises that individuals encounter at filing time?
So I think surprises are pretty much derived from not tax planning throughout the year or at the end of the year, but like some of the surprises that clients have seen in the past is they really get taken off guard by some of the investment income and realized capital gains that they might have incurred during the year, but they don't see the effect of the cash on that, so they take the realized gains from the investment. They might reinvest into another investment, and you kind of seen it in a couple of prior tax seasons where clients they realized capital gains that were significant, but then they rolled it into a new investment. But then when it came time to prepare their tax return, and they had a significant balance due on their 1040, so they had to figure out ways to kind of move cash around to pay that balance due on their 1040. So and also some other surprises, like you can also have K1 investments that that spit off significant income on that you have to report on your 1040, and it might not be easy to get the estimates from some of those K1s during the year or even at year-end tax planning. So if you're just basically paying in estimated tax payments based on safe harbor, you could also and then those investments generate significant income, you could be surprised by a significant tax bill when you're going to file your tax return.
Wow. Okay. Well, I think one of the pieces that is getting complex this year is new legislation, right? So let's shift gears a little bit and talk about something that is really affecting almost every taxpayer this year. Back in July of 2025, the OBBBA, that's a tongue twister, the One Big Beautiful Bill Act was passed. So that locked in some provisions, it, adjusted some other ones, created new planning considerations for individuals. How is the OBBBA impacting individual taxpayers this year?
So what's going to impact the individual taxpayer this year is, want to touch upon like the changes to the income thresholds that were made permanent by the new bill. Also, there are some adjustments and deductions that, and also credits that were changed as well. And so we also want to touch upon, what are the impacts of this new bill on high earners, and also, the effects of the pass-through income and how it could affect your personal tax return. And also we want to touch upon the Trump accounts that are a new type of individual retirement account.
Wow, there's definitely a lot in that bill, a lot of different provisions. So let's go through each of these just in a little bit more detail. Can we start with the changes in income thresholds?
So the TCJA, which is the Tax Cuts and Jobs Act of 2017, it pretty much just, it lowered the individual tax brackets, and it also widened the amount of income in those brackets for your threshold. So that was set to expire at the end of 2025, but now, with the new bill, the One Big Beautiful Bill Act, it made it permanent, and it just, there's just adjustments for inflation on it as well. So that's just one change when it came to, it just making it permanent. So, and also there's the Tax Cuts and Jobs Act also, increased the standard deduction that was made permanent as well. So that elevated standard deduction, it's going to benefit most taxpayers, but if you're a high income taxpayer, but you have, you have low deductions, you might see minimal gains from that. Also, the loss of the personal exemption that was, that we had on your return, prior to TCJA, that's also, it's gone as well. So.
Okay. So diving into another piece of this, what about the adjustments to deductions or credits? Can you run through some of those for me?
Yeah, so some of the major ones that I want to talk about, and all these deductions, they're pretty much based on your income, your modified adjusted gross income. But for the first one, it's like the SALT deduction. So in the past, in the prior years, like you've been capped at $10,000 on the amount of taxes you could claim on your Schedule A for your itemized deduction. So that increased to $40,000 now for married filing jointly. So you're able to, taxpayers who are not, above the $600,000 in income range, or might see benefits of that, increase in that deduction if they have, high real estate taxes, or they pay high, state income taxes as well. So just one thing you got to look out for that, in terms of planning and stuff like that. Say if there, if that might be beneficial or not due to the alternative minimum tax.
I keep hearing all about this no tax on tips and no tax on overtime, and I feel like there are some misconceptions about what that really is. Can you jump into that a little bit and help me understand what those two provisions mean?
Yeah, so for the no tax on tips and the reporting, so basically the no tax on tips, you're up to, you get a deduction for up to $25,000 on your tax return. So, and then you have to also just be awareful of the, the income limits in that as well. So, so basically it's only the cash tips that qualify. So, and if the employer's not really required to report those cash tips to you in the current tax filing season, that's going to be on next year's W-2. But you might want to still look at your W-2 for the W-2 box 7 for those tips that you maybe use. You're able to report it on your tax return. So, and then for the no tax on overtime is, so basically, if that's not reported in box, 14 of your W-2, you're going to have to look at your pay stub. So, and you have to, correspond with your accountant and provide your accountant your pay stub from your last paycheck. So basically, for the no tax on overtime, you're able to get a $12,000 500 deduction if you're single, or $25,000 for married filing jointly. So both for these no tax on tips and overtime, you can't get the deduction if you're married filing separately. So, and it's to keep in mind for the overtime reporting, it's actually the half, it's the half in time and a half. So basically, if it's, you look at your prior pay stub and it says like your whole overtime amount, you actually got to probably just divide that by three to get your half amount, for your pay. But sometimes on the pay stubs, they do provide you with the premium amount of the overtime that, was being paid out. So you're able to use that as well. So, and then for, another deduction I wanted to kind of, hit on is the senior deduction and the limitation. So, this comes as a planning opportunity for some seniors to maybe, take the $6,000 deduction and see where their income's at, and maybe if it makes sense to have any planning opportunities with, converting any IRAs maybe to accelerate any income to take the deduction and make it effective. So, and then the next one was also, you're able to deduct up to $10,000, for debt incurred in 2025 for a vehicle, the interest that you're paying on your loan vehicle. So the car's got to be made in the U.S. and you have to use it personally. So you can't use it for your business. So that's up to $10,000 deduction. And, for the final one, like distributions from 529 plans, can now be used for, K through 12 expenses up to 20,000 now instead of 10,000, like how it was in the prior year.
Well, it sounds like there are a lot of deductions and credits included in the OBBBA, and it's adding a lot more for people to consider when filing their taxes this year. You touched on it a little bit, but what are the impacts on high earners?
So some of the impacts, on the high earners, those individuals are hitting the 37% tax bracket. So like, as we discussed previously, like, the new bill, it made permanent the reduction of those lower tax brackets. So previously, before TCJA, there was, 39.6 was the high percent of the tax brackets. Now it's currently set at 37%. So that kind of enabled us to see where taxpayers are in the tax bracket in those high earners, and be able to, plan throughout the year how to maybe, bring some of that income down and, reduce tax. Also, some of the other impacts, you might be seeing not this filing season, but next filing season that, these high earners might have, they're going to have an overall limit on their itemized deductions, beginning with the 2026 tax year. So, their itemized deductions are going to be limited. So, compared to prior years based on, how much they're in the higher, 37% bracket. So that you're going to see that next year. And also, another big item for these high earners, with the state tax exclusion that went up to $15 million per person. So that's able to be up to like $30 million for, a state tax exclusion if you have portability.
Can you also touch on the effects on pass-through income?
Yeah, so for this filing season, you might see that a lot of business owners who have, owned pass-through entities who in the past, from like 2022 to 2024 have, significant Section 174 costs, which are research and development costs. Well, now for 2025, those business owners are able to take a deduction for those unamortized costs in 2025. So that might lower, income substantially for these business owners or those entities, and which would affect, their individual tax returns as well. So, and then some of the other provisions, with bonus depreciation, any asset that you place in service over, past January 19th, you're able to take, 100% bonus on. So that's just another big win that the business owners are able to take deductions on property that they place in service. That also goes for Section 179 as well. The new bill increased the expansion from 1 million to 2.5 million, and and also made permanent the qualified business income deduction, which was pretty much 20% of your qualified business income. So all these are going to affect the income of the individual owners of these flow through entities.
Okay, got it. The last thing that I want to touch on when it comes to the OBBBA, and I'm hearing a little bit about Trump accounts. Can you explain what those accounts are?
Yeah, so these Trump accounts are just pretty much like an individual retirement account that you can set up, and you got to clients should be able to talk with their accountants whether they should be filing Form 4547 right now, And basically on Form 4547, you can make the election to open up one of these accounts. And these accounts are pretty much for children that are born between 2025 through 2028. And so you can make the election on Form 4547 to open one of these accounts up, and also make the election to receive a pilot, contribution of $1,000 to this account. So the contributions won't start until July 4th of 2026. But you might want to start, opening an account right now, when you're filing your 2025 tax return, or you could just go online to trumpaccounts.gov and, make the election on the website. So basically, just to go into like a little bit of this, so these are basically individual retirement accounts that you could put up to $5,000 per year into. And, you need a valid social security number for the child and be able to open up one of these accounts as well.
Okay, got it. Well, thank you so much for going through each of those different provisions. I know that there is a lot in this act and, a lot of things for taxpayers to be aware of going into this tax season. So, can you kind of give me a feel for, are these changes creating more urgency around planning or more confusion?
Yeah, it does create confusion to clients, how these new bills, affect, their tax situation. But, it's also a great time and planning opportunity for us accountants to correspond with our clients, and be able to determine how these new law changes affect their tax situation. So basically, we just want to make sure you just stay in touch with your accountant throughout the year and see how, if any, your tax situation has changed, and your accountant will be able to help you plan throughout the year and at year end.
Absolutely. What types of individuals are the most impacted by these changes, would you say?
So I think it's going to vary by each individual's tax situation. You're going to see a lot of individuals who are now itemizing, with the increase in the SALT cap. Also, you could, like how I mentioned before, like the business owners with these significant 174 costs, that's going to affect them significantly in the 2025 tax year, and how they'll be able to maybe reduce their income in 2025. You also have to remember, for these business owners, they can also, elect to amortize those costs between 2025 and 2026. So it can also affect 2026 as well, if the losses don't offset all of the income as well. So I think it's going to mostly impact those business owners who have those significant 174 costs, who own those flow-through entities.
So, what are some things that individuals can do this tax season to make things run smoother?
So basically, when you first receive, you should be receiving an organizer from your accountant. So that organizer is there, whether electronically or paper copy, to help you go through, the numerous questions that are on there to see what applies to your tax situation. So it always helps, us accountants, when a client goes through in detail their tax organizer. So maybe the client, actually sees a question and says, oh, hey, that does apply to me. So, like, maybe I should ask my accountant these questions on how this affects me. So it's always a good thing to have a tax organizer just go to the client, so they could be proactive in reviewing the questions on those organizers and providing, asking their accountant, like, how those questions apply to their tax situation, just so we have all the information needed to prepare their tax return. Another thing is, after you go through that organizer, it's also, crucial to provide your accountant with your tax documents in a timely manner. You don't want to wait until the last minute to provide your accountant with, your documents and things like that. You want to be able to have time for your accountant to go through things and ask the questions and be proactive, in order to make sure you're getting the best, deductions and everything on your tax return, and lowering your tax as much as possible.
Yeah, absolutely. I mean, everything with tax season is around deadlines, right? So needing to get everything in a timely manner makes a lot of sense. I'm starting to hear some rumblings about something going on with the USPS in terms of getting things to them in a timely manner. Can you fill me in a little bit on that?
Yeah, so I guess these processing centers, where they postmark, actually process the mail, they're becoming the distance between these and the actual post office is, it's getting further away. So basically what this means is, it might take longer for your mail, if you're mailing your estimated tax payments, or you're sending in a check for your balance due for your return, it might take longer for your documents to get postmarked. So basically the IRS, relies on that postmark to date to make sure that you're paying your estimated tax payments or your balance due, or even sending in your tax returns on time. So, and then if you don't get it on time, you might be subject to some estimated tax penalties as a result. So it's always a good idea to, maybe you could go to the USPS retail counter and request a hand applied postmark, or you can maybe purchase postage at the counter, so a date verification is applied to your mail. Or you could also just consider, paying your estimated tax payments or your balance dues online instead of through the mail.
Got it. Well, those are great tips, because the last thing you want is to get everything to the post office in time and then have it not reflect, the date that you delivered everything. One thing we also talk about a lot at DHJJ, and I know you touched on it a little bit at the beginning of, this conversation, is tax planning shouldn't only happen in March and April. So what should individuals be doing throughout the year to improve next year's outcome?
So I think the first thing they should, if you're filing your tax return now, you're not going on extension, you might want to just first see how the new One Big Beautiful Bill Act affected your 2025 tax return, and correspond with your accountant how you can plan, for next year, and how the new bill changes affected your 2025 returns and how it's going to affect your 2026 return. You also, for taxpayers, with W-2s, and they had withholding and it might not have been withheld upon enough, this year you might want to consider adjusting your withholding. You also want to review your estimated tax payments that you got to make quarterly throughout the year, so that every quarter you might want to sit down with your accountant and provide information to see if you're, what changed in your tax situation, and, what estimated tax payments should you be making during, throughout the year. And it's also a good thing just to, just keep planning throughout the year, and at year end to make sure that you're timing your income and deductions correctly, and whether it's making retirement contributions at year end, or maximizing your HSA contributions, or a bunch of itemized deductions. That's just something that you want to talk with your accountant about, whether if that's going to help your tax situation or not.
Got it. So what separates someone who files reactively from someone who files proactively?
Well, if you have clients who are more proactive and are asking more questions, then that allows us as their CPA to help them more effectively. If we have clients who don't want to provide information, or who are not like as proactive in the tax return preparation, like we feel like we want to be proactive with our clients, so we know their whole tax situation, so we're able to help them the most, in an effective way for their tax return preparation.
Absolutely. I also want to talk a little bit about items that may be overlooked. I think we're all busy and taxes aren't necessarily top of mind all year round, right? So what are some of the things that taxpayers may not have done throughout the year that relate to their 1040 preparation?
So you see a lot sometimes when you are actually doing planning for these clients, and you do provide estimates. Sometimes they either underpay their estimated tax payments, or they don't pay their estimated tax payments. So you just keep in mind, if the account's providing you with estimates, to follow up on those estimates, to actually make those payments. Also, you could just, you just want to be able to just keep in contact with your accountant about, adjusting for some life changes, maybe, with terms of marriage, maybe new children, or maybe your filing status has changed during the year. Also, you don't want to overlook like some of the multi-state obligations that you might have, from your business entity. You want to make sure you're complying with the Nexus rules, and, how that affects your business and your individual returns, and you're complying with the state tax filings. And you also don't want to wait too long for the accountant to help you throughout the year to make these planning changes. So basically, it's just, keeping in touch with your accountant throughout the year.
Got it. I feel like that is one of the most important takeaways that I have gotten from everyone at DHJJ, right? Be talking to your accountant throughout the year. It is the best way to have a successful tax season. I want to go through just a couple kind of quick rapid fire style questions. So starting off, one document people forget every year.
So I think it's always, I don't know, for me, it's always, you're looking for another brokerage account or investment account, or it's a publicly traded partnership K1. I think those are sometimes overlooked. Some of these publicly traded partnership K1s you could find, like when you go through these clients' brokerage statement accounts, you see that these have these investments that they may not know of that are sitting in the brokerage account. So I think that's just probably one of the most main documents that I see every year.
What's one planning move that makes the biggest impact?
Well, I'm not sure if it's just one biggest or one plan move that makes it big. You got to look at the taxpayer's situation. So for like example, if the taxpayer has, significant taxable income, this year, you want to make sure that you're, accelerating deductions to offset that taxable income to lower their tax, whether that's, maxing out, deductions or bunching itemized deductions or, making retirement contributions or tax loss harvesting. So, and then also you could look on the other side, if the taxpayer has, a significant loss, like they might have, like with some of these business owners who have, those they were able to deduct those significant, Section 174 research and development costs in 2025, you might want to consider doing some Roth conversions on their end. So as well, and maybe accelerate a little bit of income to offset, so those losses offset some of that income. So I think it's just a different situation for depending on, if you have taxable income or you're expecting a tax loss.
Okay. And last but certainly not least, what is one question everyone should ask their CPA this tax season?
So I think it's how the One Big Beautiful Bill Act affected their 2025 tax returns, how it's going to affect their tax returns going forward. I think that's just, the main question that should be asked. And, and if there's any other things that they want to see, that they see in their organizer as well, they should be, that they don't understand, they should be asking their accountant that as well.
Absolutely. I think we could even be putting that question up in lights. Everyone should be thinking about that, talking about that. There were just so many changes that came through this year that it's important for every taxpayer to understand that and get the help that they need from their accountant and get more clarity on that. Now, to wrap up, if someone only remembers three things from today's conversation, what should they be?
Well, I think the three main things is, some of the deductions and things that we went over from the One Big Beautiful Bill Act. So it's just keep in mind those deductions and see if they apply to your tax situation. And also, one of the main things that we hit on was, tax planning. Tax planning is crucial, especially with new law changes. You want to be proactive with your client. As accountants and clients should be talking with their accountants if they have any questions at all during the year. And the last one would be, how maybe your business, affects your personal tax filings, through, multi-state reporting requirements. So those are the main three that I would think that you should get out of today's conversation.
Absolutely. Well, thank you so much, Dominic. I really appreciate you taking the time to chat with me about all of this. Like we've kind of talked about in the entire episode, is there's a lot going on this tax season. So I appreciate you going through some of the changes that have happened with the OBBBA. And this has been a very helpful reminder that individual tax planning deserves attention year round, especially when the tax laws are changing and income complexities continue to evolve. So if today's episode sparked any questions for you about your own 1040, estimated payments, or planning opportunities for the year ahead, reach out to your DHJJ advisor. And to our listeners, thank you for joining us on Ask a DHJJ CPA. Be sure to subscribe so you don't miss future episodes. And if you have questions you'd like answered in future episodes, please leave a comment or send it our way. We'll see you next time.